All right, Andrew John here, and I need you to lock in for the next few minutes, because what I'm about to share with you is not speculation. It's not theory, and it's not another financial headline that you scroll past. On January 15th, 2026, the Federal Reserve published an updated framework for reserve requirements that fundamentally changes the relationship between your cash deposits and the banking system. The reserve ratio for commercial banks with total assets exceeding $50 billion has been reduced from 10% to 3%. That means for every $100 you deposit, your bank is now only required to hold $3 in actual reserves. The other $97 can be loaned out, invested in securities, or used as collateral for derivative positions. Your cash is no longer sitting in a vault. It's actively being leveraged. And the buffer that protected you from bank runs and systemic stress has just been cut by 70%. This is not a crash. This is not a panic. This is not a rumor circulating on financial Twitter. This is a regulatory change that has already been implemented, and it tells you something critical about what the Federal Reserve sees coming. They are prepositioning the banking system for a liquidity crisis by allowing banks to operate with thinner capital cushions, which means they expect institutions to need every available dollar of lending capacity in the months ahead. And when central banks start loosening reserve requirements in the middle of an economic expansion, it's not because things are going well. It's because they're preparing for what happens when the credit mechanism seizes. Over the next several minutes, I'm going to walk you through exactly what reserve requirements are, why this change matters more than any interest rate decision you'll hear about in the mainstream media, and most importantly, what this means for your deposits, your portfolio, and the systemic risk building under the surface of this market. I'm going to show you the historical precedents, the mechanical breakdown of how this creates instability, and the 3 asymmetric positions you need to understand right now to protect yourself from what's coming. This is not about fear. This is about understanding the rules of the game while they're being rewritten in real time. So, turn off the distractions and let's break this down step by step. Before we get into the current situation, you need to understand the framework that governs every financial system in history. It's called fractional reserve banking. And if you don't understand this, you cannot possibly grasp the risk you're taking by keeping significant wealth in the traditional banking system. Fractional reserve banking means that banks do not hold all of your deposits in cash. They hold a fraction, and they lend out the rest. This system works beautifully when confidence is high and defaults are low, but it collapses catastrophically when depositors lose confidence and attempt to withdraw their money simultaneously because the cash simply does not exist. The reserve requirement is the regulatory guardrail that's supposed to prevent this collapse. It's the percentage of deposits that a bank must hold in liquid reserves, either as physical cash in the vault or as deposits at the Federal Reserve. For decades, that requirement sat at 10% for large banks. It wasn't perfect, but it created a baseline level of liquidity that could absorb moderate stress. On January 15th, that baseline was lowered to 3%. Now, let me be very clear about what this means in practical terms. If you deposit $100,000 into a checking account at a major commercial bank, that bank is now only required to keep $3,000 available. The other $97,000 is immediately deployed into the lending market, into securities purchases, into repo agreements, into the complex web of financial instruments that generate profit for the bank. And here's the critical point. That $97,000 you think is yours is now somebody else's loan, somebody else's mortgage, somebody else's corporate bond. It has been relent multiple times over through the magic of the money multiplier effect. If you and everyone else with deposits at that bank decided to withdraw your money on the same day, the bank would have $3,000 for every $100,000 in claims. That is a 97% shortfall, and there is no mechanism to cover that gap except emergency borrowing from the Federal Reserve. This is not a flaw in the system. This is how the system is designed to function, and the Federal Reserve just made it more fragile by cutting the reserve cushion by 70%. Now, Let's talk about why this matters right now in this specific macro environment. Because timing is everything. The United States is carrying over $36 trillion in federal debt. Corporate debt has exceeded $13 trillion. Household debt is approaching $18 trillion. We are sitting on the largest debt pile in human history, both in nominal terms and as a percentage of GDP. And that debt was accumulated during a decade of near-zero interest rates when borrowing was essentially free. But rates are no longer near zero. The Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. And even though they've paused or cut modestly since then, the damage has been done. The cost of servicing all of that debt has exploded. Corporations that borrowed at 2% are now refinancing at 6% or 7%. Governments that issued bonds at rock-bottom yields are now facing fiscal crises as interest payments consume larger and larger portions of tax revenue. And consumers who took out variable rate loans are seeing their monthly payments double or triple. This creates a deflationary feedback loop. Higher debt service costs mean less money available for consumption and investment. Less consumption means weaker economic growth. Weaker growth means lower tax revenues and higher default rates. Higher default rates mean banks take losses on their loan portfolios. And when banks start taking losses, they pull back on lending, which makes the deflationary spiral worse. The Federal Reserve knows this. And they also know that the traditional playbook, lowering interest rates to stimulate borrowing, is politically and economically constrained because inflation is still above target. And lowering rates risks reigniting inflationary pressures. So instead of lowering rates, they're doing something more subtle and more dangerous. They're lowering reserve requirements to free up bank capital for lending without having to cut rates. This is financial engineering at its finest, and it's a signal that the Fed is more concerned about a credit crunch than they are about inflation. Let me walk you through the timeline of how we got here because context matters. In March 2020, at the onset of the CO9 pandemic, the Federal Reserve made an emergency decision to reduce reserve requirements to 0%. Zero. Banks were allowed to lend out 100% of deposits with no reserve buffer whatsoever. The justification was that the economy was in freefall and credit needed to flow freely to prevent a complete collapse. That emergency measure was supposed to be temporary, but it stayed in place for over 2 years. It wasn't until late 2023 that the Fed began reintroducing reserve requirements, initially at 5%, then adjusted to 10% in mid-2024 as part of what they called a normalization process. But now, just 18 months after reinstating a 10% requirement, they've cut it back down to 3%. That's not normalization. That's desperation masked as policy flexibility. And if you look at what else has been happening in the banking sector over the same period, the picture becomes even clearer. In March 2023, Silicon Valley Bank collapsed in the second largest bank failure in United States history. It was followed by Signature Bank and First Republic, all within a matter of weeks. The approximate cause was a classic asset-liability mismatch. These banks had loaded up on long-duration treasury bonds and mortgage-backed securities during the zero-rate era. And when rates spiked, the market value of those bonds cratered. The banks were technically insolvent on a mark-to-market basis, even though their depositors had no idea. When word got out, depositors ran and the banks collapsed. The Federal Reserve and the FDIC intervened with emergency backstop facilities, guaranteeing deposits above the $250,000 insurance limit and providing liquidity to other regional banks to prevent contagion. That intervention worked in the short term. The panic subsided, but it didn't solve the underlying problem. Regional banks across the country are still sitting on massive unrealized losses in their securities portfolios. According to FDIC data, United States banks were holding approximately $650 billion in unrealized losses on securities as of Q3 2025. That's $650 billion your deposits that are backing assets worth significantly less than their book value. And now the Fed has just told these same banks that they can operate with even less liquidity cushion. Here's the mechanism that most people miss. And this is where the systemic risk becomes terrifying. When a bank holds only 3% reserves, it means that 97% of deposits are tied up in illiquid or semi-liquid assets, loans, bonds, derivatives, securities. If a shock hits the system, whether it's a wave of corporate defaults, a commercial real estate collapse, or a geopolitical crisis that spooks markets, those assets can lose value rapidly. But the deposits, your deposits, remain as liabilities on the bank's balance sheet at full face value. This creates an instant solvency problem. The bank owes you $100, but the assets backing that liability are now worth $80 or $60 or even less. If you try to withdraw your money, the bank has to sell assets at a loss to raise cash, which makes the solvency problem worse. And if other depositors see the bank selling assets at a loss, they panic and try to withdraw their money too, which forces more asset sales at even steeper losses. This is the classic banker-run dynamic, and it's exactly what happened in 2023. The only reason it didn't cascade into a full systemic meltdown is because the government stepped in with unlimited guarantees. But here's the question you need to ask yourself. Can they do that again? The political environment has changed. There is significantly less appetite for bank bailouts than there was in 2008 or even 2020. The debt levels are higher, which constrains fiscal flexibility, and the public is far more skeptical of interventions that seem to benefit Wall Street at the expense of Main Street. If another wave of bank failures hits, the tools available to contain it are more limited, and the reserve requirement reduction we're seeing now suggests the Fed knows that liquidity will be the choke point. Now, let's connect this to the broader macro picture, because the reserve requirement change doesn't exist in isolation. It's part of a coordinated set of policies that are all pointing in the same direction. At the same time that reserve requirements are being cut, the Federal Reserve has extended the Bank Term Funding Program through June 2026. The BTFP was created as an emergency facility during the March 2023 banking crisis to provide liquidity to banks that needed to borrow against their securities portfolios without having to sell at a loss. It was supposed to be temporary, but it's now been extended 3 times. That tells you that banks are still under stress and still relying on Fed support to maintain liquidity. Meanwhile, commercial real estate delinquencies are accelerating. Office buildings, retail centers, and even multi-family properties are seeing rising vacancy rates and falling valuations as work-from-home trends persist and consumer spending weakens. According to data from TRE, the delinquency rate on commercial mortgage-backed securities hit 6.8% in December 2025, the highest level since 2014. And remember, regional banks hold approximately 70% of all commercial real estate loans in the United States. When those loans start defaulting, the losses flow directly onto bank balance sheets, which are already strained by unrealized losses on securities. Add to that the maturity wall we've discussed in previous videos. Over $1.5 trillion in commercial real estate debt is maturing in 2026 and 2027. And the vast majority of it cannot be refinanced at current interest rates without the borrowers injecting massive amounts of new equity. Many borrowers don't have that equity, which means they'll default, and the banks will be forced to take ownership of properties worth far less than the loan balances. This is a slow-moving train wreck, and the reserve requirement cut is the Fed's way of giving banks more breathing room to absorb the losses without having to raise capital or curtail lending, but it comes at the cost of systemic stability. Let's talk about historical precedent because this is not the first time reserve requirements have been used as a crisis management tool. In the lead-up to the Great Depression, reserve requirements were inconsistent and often inadequate. Banks operated with thin capital buffers, and when the stock market crashed in 1929 and the economy contracted, depositors lost confidence and rushed to withdraw their funds. Between 1930 and 1933, over 9,000 banks failed, wiping out the savings of millions of Americans. The Federal Reserve was created in 1913 in part to prevent exactly this kind of cascade. But in the early 1930s, it failed to act as a lender of last resort, and the banking system collapsed. The lesson learned from that catastrophe was that reserve requirements matter. They are a critical buffer that prevents isolated shocks from becoming systemic crises. In response, the Banking Act of 1933 created the FDIC and established standardized reserve requirements to ensure that banks maintained adequate liquidity. For decades, those requirements provided stability. But over time, as financial markets evolved and banks became more sophisticated, the requirements were viewed as archaic constraints on profitability. The deregulation wave of the 1980s and 1990s chipped away at those standards, and by the 2000s, banks were operating with increasingly complex balance sheets and thinner capital cushions. The 2008 financial crisis was the inevitable result. Banks had leveraged themselves to absurd levels, and when the housing market collapsed, the entire system nearly went down with it. The response was supposed to be a return to prudence. Dodd-Frank and Basel III regulations were implemented to increase capital requirements and reduce leverage. But here we are in 2026, and the Fed is moving in the opposite direction, cutting reserve requirements at a time when systemic risk is arguably higher than it was in 2008. The second historical parallel is the savings and loan crisis of the 1980s and early 1990s, which is less well known but highly relevant. Savings and loan institutions, or SNLs, were specialized banks that focused on residential mortgage lending. During the 1970s and early 1980s, they got caught in a brutal interest rate squeeze. They had issued long-term fixed-rate mortgages at low rates. But when Paul Volcker raised rates aggressively to fight inflation, the cost of their deposits skyrocketed while their mortgage income remained fixed. This created massive losses, and over 1,000 SNLs failed between 1986 and 1995. The total cost to taxpayers was over $130 billion, equivalent to over $300 billion in today's dollars. The SNL crisis was a textbook example of what happens when financial institutions are allowed to operate with inadequate capital buffers and take on duration risk that they cannot manage. The regulatory response at the time was to tighten oversight and increase reserve requirements. But the lesson seems to have been forgotten, and we're now seeing banks take on similar risks in commercial real estate and securities portfolios, while being allowed to operate with even thinner reserves. So what are the three asymmetric plays in this environment? Let me be very direct about this because positioning is everything. The first play is physical precious metals, specifically gold and silver held outside the banking system. I'm not talking about ETFs. I'm not talking about mining stocks. I'm talking about physical metal that you control directly. The reason this is asymmetric is simple. When reserve requirements are this low and systemic risk is this high, you cannot afford to have all of your wealth in the form of bank deposits that are claims on an institution's solvency. Physical gold and silver are the only assets that have no counterparty risk. They cannot be diluted by a central bank printing press. They cannot be bailed in by a failing institution. And they have functioned as money and stores of value for 5,000 years, across every civilization and every currency crisis. Right now, central banks around the world are buying gold at record pace. In 2024, central banks purchased over 1,000 metric tons of gold, the second highest annual total on record. China, Russia, India, Turkey, and Middle Eastern sovereign wealth funds are all accumulating. They understand that in a world of fiat currency debasement and systemic banking fragility, gold is the ultimate reserve asset. If you don't have at least 10 to 20% of your liquid net worth and physical precious metals stored securely outside the banking system, you are taking on uncompensated systemic risk. The second asymmetric play is high-quality distressed credit and deep-value equities in sectors that are being indiscriminately sold off. When credit markets tighten and banks pull back on lending, quality businesses with strong cash flows and manageable debt loads get thrown out with the garbage. This creates opportunities to buy assets at significant discounts to intrinsic value. The key is to focus on companies with fortress balance sheets, recession-resistant revenue streams, and management teams that understand capital allocation. Energy infrastructure, utilities, consumer staples, and select healthcare companies often fit this profile. You want businesses that can generate cash flow regardless of the macro environment and that are trading at valuations that already price in a severe downturn. The asymmetry comes from the fact that if the crisis materializes, you're buying at Depression-era prices. And if it doesn't, you still own quality assets at a discount. The third play is short-duration inflation-protected instruments and hard assets with intrinsic value. This includes Treasury inflation-protected securities, or TIPS, if you can get them at reasonable real yields, short-term corporate bonds from high-quality issuers, and real assets like productive farmland, energy royalties, and water rights. The goal here is to avoid long-duration exposure where you're locked into fixed nominal returns that get destroyed by inflation. Instead, you want assets that either adjust for inflation automatically or that have pricing power in an inflationary environment. Hard assets, things you can touch that produce real economic value, are the ultimate hedge against both currency debasement and financial system instability. Now, let's talk about the signals that tell us this situation is escalating. The reserve requirement cut is one data point, but it's not the only one. In the last 90 days, we've seen the Federal Reserve extend the Bank Term Funding Program. We've seen commercial real estate delinquencies rise. We've seen regional bank stocks underperform the broader market. And we've seen credit spreads widen in high-yield debt markets. These are all signs that stress is building under the surface. At the same time, the Federal Reserve has stopped publishing certain monetary aggregates in real time, which reduces transparency into money supply growth and credit creation. The Treasury Department has been issuing a higher,